Hello, everybody. Welcome to Clever Investments. Let's continue to talk about leveraged ETFs. So although we have analyzed the leveraged ETFs and recommended not to buy it, but if you look at the last 10 years, you find that it's beating the market. You get more return than the index. So many people may think that they don't want to be left out. And here, let's analyze where does the profit of leveraged ETF come from? So I ask this question because remember my CLEF principles, the first letter C, stay conscious. So I want to make sure I understand the money I make, where it is from, so that I don't need to be too greedy. If this is a zero-sum game or something that doesn't make sense, I wouldn't invest in it. Okay, so if the market is going well, like it's in a bull market, and if many people are buying 2x ETF, then they all beat the market. But we all know that it's impossible for everybody to beat the market. So where is the catch? Let's look at how the leverage ETF or 2x ETF works. So for the ETF to work, it must rebalance at the end of each day so that if the index goes up by 1%, ETF need to buy some more shares at the end of the day so that it can gain 2% on that day. So basically, if stock grows, your leveraged ETF needs to buy more shares of that index at the end of the day. So market already goes up on that day, but those ETF rebalance activity will make the market grows more. If somebody buy the inverted leveraged ETF, where if index goes up, the ETF goes down, those ETF also need to do rebalance. And when stock grows, those ETF also need to buy more. So they are the same in this rebalance activity. And also, if the stock drops, the leveraged ETF need to sell more to reduce their leverage. And market already drops. When they sell more, they would make the market drops even more. So both these activities make the market more volatile. If the market goes up, they want to make market goes up more. That increases the volatility. And we already know that if the market is more volatile, it's not good for the leveraged ETF. If it's volatile enough, it would make leveraged ETF lose money. So that means if everybody is buying 2x ETF, it's impossible for everybody to beat the market. Only if not enough people buy it, and if the market's volatility is low enough, then they can make money and beat the index. So this only works when there's enough people don't buy the leveraged ETF. But leveraged ETF in recent years is becoming more and more popular, and it's already making the market more volatile. So actually, there is this paper, it's almost 10 years ago. It looked at the market volatility, and the paper found that there's a lot of volatility caused by the potential rebalancing trades for the leveraged ETFs. And also, this rebalance activity make it possible for front runners to take some profit of the leveraged ETF. So what are these front runners? So they know that lots of ETF would do a rebalance at the end of the day. So if market goes up, those ETF will have to buy more. And those front runners would be able to predict this rebalance activity and buy more first, and then sell those to the leveraged ETF rebalance. So that means those leveraged ETF will be forced to buy at an even higher price. And that will cause more loss to the leveraged ETF. So overall, leveraged ETF, I don't believe it's something that we should buy and hold for a long time. And I would try to avoid it. Buy and hold the simple market index, such as S&P 500 or Nasdaq 100. That is a better way to invest for the long term. Okay, that's all for today. Thank you.